Hi, guys. Welcome to today's live. We are going to be reading Chapter 9 of The Intelligent Investor by Benjamin Graham, Investing in Investment Funds. My name is May Doldelau, and my blog is yesfinanciallyfree.com. If you are not a subscriber, go to yesfinanciallyfree.com right now. In YouTube, it's a link under this video, and in Instagram, it's my profile link. Go there, put your first name and email address on the right side, and get on my email list. Now, a lot of you have done that, so thank you. I appreciate it. So if you haven't already, go to yesfinanciallyfree.com, put your first name and email address on the right side, and I will tell you what I will be broadcasting about. So that's the first perk, okay? That way you'll always know, and then if you want to tune in live or not, you can tune in, all right? If you're not a subscriber already on the YouTube channel, which is Creative Abundance Now, go ahead and subscribe. And if you are watching this and love it, share it with your friends, okay? So my name again is May Doldelau. I blog about financial freedom, and I also have a coaching program called Finance Freedom Mastermind, where I coach clients on how to create passive income while paying off debt at the same time and improve your net worth. So it's a program where we focus on creating a financially free lifestyle where we improve our financial IQ and actually create more free time. So how can you measure it? You measure it in terms of passive income. You measure it in terms of the quality of your life. You measure it in terms of how much free time you have. So there's a lot of ways to measure financial freedom, okay? So my story, really quickly, in 2011, I had tons of debt. Started making that debt in 2008, 2009. Ended up with over $41,000 of debt in 2011, with over 8 different credit cards and lines of credit. None of this is collateralized, all personal debt. By 2016 of April, I paid it all off. And by December of that time, our net worth had improved by $500,000. We were making passive income of almost $500 a month. And I quit my job at the bank where I was working. I was a private banking assistant. And I became a full-time mommy, part-time finance freedom coach, and I continued blogging about financial freedom. Created 3 mastermind groups in 2017, went on 1 month of vacation, went on our first cruise, my first cruise, to my son and my first cruise. We went to the Mexican Riviera for 7 days. It was so fun. It was one of my dreams to do that. We went to Niagara Falls to visit family, and also in Buffalo, Toronto. We went to Washington, D.C. to visit my sister. We went to L.A. It was amazing. And we also bought our first property in Waikiki. And then in 2018, we bought our second property in Waikiki, which is an Airbnb business, which we employ my mother. She is the cleaner and the manager of the business. And then in 2019, we sold our first condo, which we were living in at the time. Actually, we turned it into an Airbnb business. So we had 2 Airbnb businesses for a while. We sold that one to one of our mastermind members. So then we bought this condo, which is a lot larger, and we live in this one. So we own a condo that we live in and own one that we have a business in. And so if you're interested in our program, my program, financefreedommastermind.com, you can go there, or you can go to yesfinanciallyfree.com, go to the products tab, and then it has all the programs that we offer our clients. It ranges from, if you join the email list, you get a free ebook, Working Parents Guide to Financial Freedom, okay? But we also have a $7 program, 7-day Finance Freedom Challenge, where you learn to make 2 streams of passive income, one with a high yield savings account, one with learning how to buy your first dividend-yielding stock. There's the 1-year Finance Freedom Makeover program, where you get recordings of an actual mastermind group and what they learned through the entire year, how they increase their net worth, how they increase their passive income, and how you can do it too. And you can also, that's only $97, which is a deal. And right now, if you get that product, you also get access to online office hours. So you jump in online, ask any questions, or talk to me or anything for 1 hour every week on Zoom. So that's a great deal. For a whole year, you get access, which is phenomenal. The other product is Finance Freedom Training Live. You get the recordings and you get the office hour, but you also get a once a month personal coaching session with a live coach, finance freedom coach on your own, and you do your own numbers every month. You calculate your cash flow, your net worth, your financial freedom account, and your passive income. Then you strategize and get the next steps and how to increase it for the next month. Okay, so you do that every month for a year. Or you can actually, that one's ongoing, so you can stay in the program as long as you like. It's $197 a month. And then the final one is Finance Freedom Mastermind, where you meet with a group together with your coach for 40 minutes a week. That's recorded. Then you get the office hour, and you get the monthly coaching session, and you get invited to the yearly Finance Freedom Celebration Christmas party, which is always on the day that I quit my job, so and became financially free officially, not having to work a job at the bank anymore. So that is every year. I send out invitations. It's on December 23rd in Hawaii. So you get a lot of perks. These are the different products we have offered. The mastermind is $5,000 for an entire year, which is a great deal. And you get so much out of it. So go to yesfinanciallyfree.com to see all that, all the different products, see if one of them sounds good to you. And if it does, go ahead and sign up. All right. All right, I'm going to begin reading the chapter. So why am I reading this book? I actually am reading a book, at least one book every month, to increase my knowledge of finance, investing, financial freedom. And this is the book that Warren Buffett read and he studied under Benjamin Graham. Okay. And that's how he learned how to become a great investor. And as you all know, Warren Buffett is probably one of the best investors of all time. Yes. And he highly recommends Benjamin Graham. So this book is required reading if you want to be a real investor. Okay, so I'm reading this book out loud. For me, the first time reading. So I'm reading for the first time, and you can join me. Okay, so I'm reading one chapter a day. I did skip yesterday. I was tired and I slept in because I was just exhausted yesterday. I am a full-time mother, and because of the COVID-19 pandemic, I am also now my son's homeschool teacher. And so it's, I just couldn't take it anymore. I needed more sleep. So I got more sleep yesterday. And I did say that I would do it as long as I could. And my son does wake up often while I'm reading. So we'll do our best. But today I'm going to read the next chapter. We will finish this book within 30 days because I have to do that for my goal. I have a personal goal of reading one book a month. So this is the book. So we're going to finish it. And let's do it together. Okay. So we're going to increase our financial IQ together. And if you want to see the replay, you can go to my blog. As I said, yesfinanciallyfree.com. There's a blog post with all the replays on it right there. Okay. It's called The Summary of the Intelligent Investor of Benjamin Graham. All right. So latest blog post. So, and we are broadcasting live on that blog post as we speak. Okay. So we're live on YouTube, but we're also live on the blog, and we're live on Instagram. If you want to like me on Instagram, it's May Doldelau. My name, May Doldelau. So let us begin. So excited to be back, guys. Investing in investment funds, Chapter 9. One course open to the defensive investor is to put his money into investment company shares. Those that are redeemable on demand by the holder at net asset value are commonly known as mutual funds or open-end funds. Most of these are actively selling additional shares through a core of salesmen. Those with non-redeemable shares are called closed-end companies or funds. The number of their shares remains relatively constant. All of the funds of any importance are registered with the Securities and Exchange Commission, or the SEC, and are subject to its regulations and controls. The industry is a very large one. At the end of 1970, there were 383 funds registered with the SEC, having assets totaling $54.6 billion. Of these 356 companies with $50.6 billion were mutual funds, and 27 companies with $4 billion were closed-end. There are different ways of classifying the funds. One is by the broad division of their portfolio. They are balanced funds if they have a significant, generally about 1/3 component of bonds, or stock funds if their holdings are nearly all common stocks. There are some other varieties here, such as bond funds, hedge funds, letter stock funds, etc. Another is by their objectives, as their primary aim is for income, price stability, or capital appreciation or growth. Another distinction is by their method of sale. Load funds add a selling charge, generally about 9% of asset value on minimum purchases, to the value before charges. So others, known as no-load funds, make no such charge. The managements are content with the usual investment counsel fees for handling the capital. Since they cannot pay salesmen's commissions, the size of the no-load funds tends to be on the low side. The buying and selling prices of the closed-end funds are not fixed by the companies, but fluctuate in the open market, as does the ordinary corporate stock. Most of the companies operate under special provisions of the income tax law, designed to relieve the stockholders from double taxation on their earnings. Most of the companies operate under special provisions of the income tax law, designed to relieve the stockholders from double taxation on their earnings. In effect, the funds must pay out virtually all their ordinary income, i.e. dividends and interest received less expenses. In addition, they can pay out their realized long-term profits on sales of investments in the form of capital gains dividends, which are treated by the shareholders if they were his own security profits. There is another option here which we omit to avoid clutter. Nearly all the funds have but one class of security outstanding. A new wrinkle introduced in 1967 divides the capital into a preferred issue, which will receive all the ordinary income, and a capital issue or common stock, which will receive all the profits on security sales. These are called dual-purpose funds. Many of the companies that state their primary aim is for capital gains concentrate on the purchase of the so-called growth stocks, and they often have the word growth in their name. Some specialize in a designated area, such as chemicals, aviation, overseas investments. This is usually indicated in their titles. The investor who wants to make an intelligent commitment in fund shares has thus a large and somewhat bewildering variety of choices before him, not too different from those offered in direct investment. In this chapter, we shall deal with some major questions, viz. Number 1, is there any way by which the investor can assure himself of better than average results by choosing the right funds? Sub-question, what about the performance funds? They have a footnote here. The sales charge is universally stated as a percentage of the selling price, which includes the charge, making it appear lower than if applied to net asset value. We consider this a sales gimmick unworthy of this respectable industry. Okay. Number 2, if not, how can he avoid choosing funds that will give him worse than average results? And number 3, can he make intelligent choices between, hi Kazar, by the way, can he make intelligent choices between different types of funds? Example, balanced versus all stock, open end versus closed end, load versus no load. Investment fund performance as a whole. Before trying to answer these questions, we should say something about the performance of the fund industry as a whole. Has it done a good job for its shareholders? In the most general way, how have fund investors fared as against those who made their investments directly? We are quite certain that the funds in the aggregate have served a useful purpose. They have promoted good habits of savings and investment. They have protected countless individuals against costly mistakes in the stock market. They have brought their participants income and profits commensurate with the overall returns from common stocks. On a comparative basis, we would hazard the guess that the average individual who put his money exclusively in investment fund shares in the past 10 years has fared better than the average person who made his common stock purchases directly. This was back in 1972, okay? The last point is probably true, even though the actual performance of the fund seems to have been no better than that of common stocks as a whole. Even though the cost of investing in mutual funds may have been greater than that of direct purchase, the real choice of the average individual has not been between constructing and acquiring a well-balanced common stock portfolio, or doing the same thing a bit more expensively by buying into the funds. More likely, his choice has been between succumbing to the wiles of the doorbell-ringing mutual fund salesman on the one hand, as against succumbing to the even wilier and even more dangerous peddlers of second and third-rate new offerings. We cannot help thinking, too, that the average individual who opens a brokerage account with the idea of making conservative common stock investments is likely to find himself beset by untoward influences in the direction of speculation and speculative losses. These temptations should be much less for the mutual fund buyer. But how have the investment funds performed as against the general market? This is a somewhat controversial subject, but we shall try to deal with it in simple but adequate fashion. Table 9.1 gives some calculated results for 1961 to 1970 of our 10 largest stock funds at the end of 1970, but choosing only the largest one from each management group. It summarizes the overall return of each of these funds from 1961 to 1965, 1966 to 1970, and for the single years 1969 to 1970. We also give average returns results based on the sum of one share of each of the 10 funds. These companies had combined assets of over $15 billion at the end of 1969, or about 1/3 of all the common stock funds. Thus, they should be fairly representative of the industry as a whole. In theory, there should be a bias in this list on the side of better than industry performance, since these better companies should have been entitled to more rapid expansion than the others, but this may not be the case in practice. Some interesting facts can be gathered from this table. So I'll show you guys the table if you want to screenshot it or whatever you guys do. Table. Okay, so looking at the table, they have these different funds: Affiliated Fund, Dreyfus, Fidelity Fund, Fundamental Investor, Investment Company of America, Investors Stock Fund, Massachusetts Investment Trust, National Investors, Putnam Growth, United Accumulated. So they show 5 years from 1961 to 1965, the percent that they grew, I guess is what that says. Yeah.
Mommy.
And the average stock market went up 77. And the only one that beat that was Fidelity Fundamental Investment Company of America. Everyone else was lower. Yes, Jordan. The Dow Jones was 78%. What happened to the one you had already? You had a plastic bag with your Pokemon cards in it.
But Daddy, take yours somewhere.
Go brush your teeth.
Daddy, give me.
Not right now, but later. Okay.
How long?
In 1966 to 1970, they talk about the increase, and Standard & Poor's went up 16%, Dow Jones went up 2%, and they show the funds, and they went up a substantial amount, most of them, except for Fundamental only went up 1%, Investor Stock went up 5%, and United Accumulated went down 2%. They decreased. In 10 years, the overall return was higher for like half of them and then lower for half of them. And most of them were higher than the Dow Jones, but some were lower. And 1969, most of them were on the down because the stock market in general was on the down, except for this National Investors one. And in 1970, about half were up and half were down. And the Dow Jones and Standard & Poor's were up. Okay, that's kind of like a summary looking at the table, but let's read what he says. Some interesting facts can be gathered from this table. First, we find that the overall results of these 10 funds for 1961 to 1970 were not appreciably different from those of the Standard & Poor's 500 stock composite average, or the S&P 425 industrial stock average, but they were definitely better than those of the Dow Jones industrial average. This raises the intriguing question as to why the 30 giants in the Dow Jones industrial average did worse than the much more numerous and apparently rather miscellaneous list used by Standard & Poor's. A second point is that the fund's aggregate performance as against the S&P index has improved somewhat in the last 5 years compared with the preceding 5. Fund's gain ran a little lower than the S&P's in 1961 and 1965, and a little higher than the S&P's 1966 to 1970. The third point is that a wide difference exists between the results of the individual funds. We do not think the mutual fund industry can be criticized for doing no better than the market as a whole. Their managers and their professional competitors administer so large a portion of all marketable common stocks that what happens to the market as a whole must necessarily happen approximately to the sum of their funds. Note that the trust assets of insured commercial banks include $181 billion of common stocks at the end of 1969. If we add to this the common stocks of accounts handled by investment advisors plus the $56 billion of mutual and similar funds, we must conclude that the combined decisions of these professionals pretty well determine the movements of the stock averages, and that the movement of the stock averages pretty well determines the fund's aggregate results. Are there better than average funds, and can the investor select these so as to obtain superior results for himself? Obviously, all investors could not do this, since in that case, we would soon be back where we started, with no one doing better than anyone else. Let us consider the question first in a simplified fashion. Why shouldn't the investor find out what fund has made the best showing of the lot over a period of sufficient years in the past, assume from this that its management is the most capable and will therefore do better than average in the future, and put his money in that fund? This idea appears to the more practicable because in the case of the mutual funds, he could obtain this most capable management without paying any special premium for it against the other funds. By contrast, among non-investment corporations, the best managed companies sell at correspondingly high prices in relation to their current earnings and assets. The evidence on this point has been conflicting over the years, but our Table 9.1 covering the last 10 largest funds indicates that the results shown by the top 5 performers of 1961 to 1965 carried over on the whole through 1966 to 1997, even though 2 of this set did not do as well as 2 of the other 5. Our studies indicate that the investor in mutual fund shares may properly consider comparable performance over a period of years in the past, say at least 5, provided the data do not represent a large net upward movement of the market as a whole. In the latter case, spectacularly favorable results may be achieved in unorthodox ways, as will be demonstrated in our following section on performance funds. Such results in themselves may indicate only that the fund managers are taking undue speculative risk and getting away with the same for the time being. Performance funds, no. One of the new phenomena of recent years was the appearance of the cult of performance in the management. Getting there. There's a table, so it'll be less reading. It's not that bad. This is kind of a short chapter. Okay, performance funds. One of the new phenomena in recent years was the appearance of the cult of performance in the management of investment funds and even of many trust funds. We must start this section with the important disclaimer that it does not apply to the large majority of well-established funds, but only to a relatively small section of the industry which has attracted a disproportionate amount of attention. Kizar says hello from Pakistan, by the way, Jordan.
I know somebody was going to say hi.
Did you? Okay. The story is simple enough. Some of those in charge set out to get much better than average or Dow Jones Industrial Average results. They succeeded in doing this for a while, garnering considerable publicity and additional funds to manage. The aim was legitimate enough. Unfortunately, it appears that in the context of investing really sizable funds, the aim cannot be accomplished without incurring sizable risks. And in a comparatively short time, the risk came home to roost. Several of these circumstances surrounding the performance phenomenon caused ominous handshaking by those of us whose experience went far back, even to the 1920s, and whose views, for that very reason, were considered old-fashioned and irrelevant to this second new era. In the first place, on this very point, nearly all these brilliant performers were young men in their 30s and 40s, whose direct financial experience was limited to the all but continuous bull market of 1948 to 1968. Secondly, they often acted as if the definition of a sound investment was a stock that was likely to have a good rise in the market in the next few months. This led to a large commitments in newer ventures at prices completely disproportionate to their assets or recorded earnings. They could be justified only by a combination of naive hope in the future accomplishments of these enterprises with an apparent shrewdness in exploiting the speculative enthusiasms of the uninformed and greedy public. This section will not mention people's names, but we have every reason to give concrete examples of companies. The performance fund most in the public's eyes was undoubtedly Manhattan Fund Incorporated, Organized at the end of 1965, its first offering of 27 million shares at $9.25 to $10 per share. The company started out with 247 million of capital. Its emphasis was, of course, on capital gains. Most of its funds were invested in issues selling at high multipliers of current earnings, paying no dividends or very small ones, with a large speculative following and spectacular price movements. The fund showed an overall gain of 38.6% in 1967 against 11% for the S&P Composite Index. But thereafter, its performance left much to be desired, as is shown in Table 9.2. The portfolio of Manhattan Fund at the end of 1969 was unorthodox, to say the least. It is an extraordinary fact that two of its largest investments were in companies that filed for bankruptcy within 6 months thereafter. Quiet, honey. And a third faced creditors' actions in 1971. It is another extraordinary fact that shares of at least one of these doomed companies were bought not only by investment funds, but by university endowment funds, the trust departments of large banking institutions, and the like. A third extraordinary fact was that the founder-manager Manhattan Fund sold his stock in a separately organized management company to another large concern for over 20 million in its stock. At that time, the management company sold had less than 1 million in assets. That's so bad. This is undoubtedly one of the greatest disparities of all times between the results of the manager and the managees. So the manager made $20 million and all the people lost their money, I guess is what he's saying. So he shows that the investments that this company made, and he has a table of the investments that investment fund made. If you want to screenshot it or look at it, that's the table. It shows how many shares of each one they had, what the price was, what their earnings were, their dividend. Most of them had no dividends, and the market value in millions of dollars. And then he shows how the Manhattan Fund did from 1966 to 1971. So it outperformed the S&P until 1968. So for 2 years it outperformed, and then it vastly underperformed the S&P index. Probably because a lot of his companies went out of business, bankrupt, so on. Okay. A book published at the end of 1969 provided profiles of 19 men who are tops at the demanding game of managing billions of dollars of other people's money. The summary told us further that they are young, some earn more than $1 million a year, they are a new financial breed, they all have a total fascination with the market, and a spectacular knack for coming up with winners. Fairly good idea of the accomplishments of this top group can be obtained by examining the published results of the funds they manage. Such results are available for funds directed by 12 of the 19 persons described in The Money Managers. Typically enough, they showed up well in 1966 and brilliantly in 1967. In 1968, their performance was still good in the aggregate, but mixed as to individual funds. In 1969, they all showed losses, with only one managing to do a bit better than the S&P Composite Index. In 1970, their comparative performance was even worse than in 1969. We have presented this picture in order to point a moral, which perhaps can best be expressed by the old French proverb, plus sa chance, plus c'est la même chose. Bright and energetic people, usually quite young, have promised to perform miracles with other people's money since time immemorial. So this is something that has happened throughout history. Young people promising to do better with the money of older people or anybody. They have usually been able to do it for a while, or at least to appear to have done it, and they have inevitably brought losses to their public in the end. About a half a century ago, the miracles were often accompanied by a flagrant manipulation, misleading corporate reporting, outrageous capitalization structures, and other semi-fraudulent financial practices. If you've ever seen The Wolf of Wall Street, right, that's kind of similar, yeah. All this brought on an elaborate system of financial controls by the SEC, as well as a cautious attitude toward common stocks on the part of the general public. The operations of the new money managers in 1965 to 1969 came a little more than one full generation after the shenanigans of 1926 to 19 1929. So they're the next generation of the people who caused the Great Depression, is what he's saying. The specific malpractices banned after the 1929 crash were no longer resorted to. They involved the risk of jail sentences. But in many corners of Wall Street, they were replaced by newer gadgets and gimmicks that produced very similar results in the end. Outright manipulation of prices disappeared, but there were many other methods of drawing the gullible public's attention to the profit possibilities in hot issues. Blocks of letter stock could be bought well before the quoted market price, subject to undisclosed restrictions on their sale. They could immediately be carried in their reports at their full market value, showing a lovely and illusory profit, and so on. It is amazing how, in a completely different atmosphere of regulation and prohibitions, Wall Street was able to duplicate so much of the excesses and errors of the 1920s. No doubt there will be new regulations and new prohibitions. The specific abuses of the late 1960s will be fairly adequately banned from Wall Street, but it is probably too much to expect that the urge to speculate will ever disappear, or that the exploitation of that urge can ever be abolished. It is part of the armament of the intelligent investors who know about these extraordinarily popular delusions and to keep as far away from them as possible. The picture of most of the performance funds is a poor one if we start after their spectacular record in 1967. With the 1967 figures included, their overall showing is not at all disastrous. On that basis, one of the money managers' operators did quite a bit better than the S&P Composite Index. 3 did distinctly worse, and 6 did about the same. Let us take as a check another group of performance funds, the 10 that made the best showing of 1967, with gains ranging from 84% up to 301% in that single year. Of these, 4 gave a better overall 4-year performance than the S&P if the 1967 gains are included, and 2 excelled the index in 1968 to 1970. None of these funds were large, and the average size was about 60 million. Thus, there is a strong indication that the smaller size is a necessary factor for obtaining continued outstanding results. The foregoing account contains the implicit conclusion that there may be special risk involved in looking for superior performance by investment fund managers. All financial experience up to now indicates that large funds, soundly managed, can produce, at best, only slightly better than average results over the years. If they are unsoundly managed, they can produce spectacular but largely illusory profits for a while, followed by inevitably calamitous losses. There have been instances of funds that have consistently outperformed the market averages for, say, 10 years or more, but these have been scarce exceptions, having most of their operations in specialized fields with self-imposed limits on capital employed and not actively sold to the public. Closed-end versus open-end funds. Almost all the mutual funds or open-end funds which offer their holders the right to cash in their shares at each day's valuation of the portfolio have a corresponding machinery for selling new shares. By this means, most of them grow in size over the years. The closed-end companies, nearly all of which were organized a long time ago, have a fixed capital structure and thus have diminished in relative dollar importance. Open-end companies are being sold by many thousands of energetic and persuasive salesmen. The closed-end shares have no one especially interested in distributing them. Consequently, it has been possible to sell most mutual funds to the public at a fixed premium of about 9% above net asset value to cover salesmen's commissions, etc. While the majority of closed-end shares have been consistently obtainable at less than their asset value, this discount price has varied among individual companies, and the average discount for the group as a whole has also varied from one date to another. Figures on this point for 1961 to 1970 are given in Table 9.3. That is Table 9.3. Guys, you can see that in Table 9.3. Okay. No, it does not take much shrewdness to suspect that the lower relative price for a closed-end as against open-end shares has very little to do with the difference in the overall investment results between the two groups. That this is true is indicated by the comparison of the annual results for 1961-1970 of the two groups included in Table 9.3. So he shows the average discount of closed-end funds, the discount, and then he shows the average results of closed-end funds and the average results of mutual funds. And then he shows the results of the S&P index. And just looking at it, the discount is like between like, there's a plus 7%, which I'm not sure. And then there's like a negative 14, negative 12, negative 5, negative 8. So there's different percent discounts. The average results, mostly positive, like 13%, 15%. Some are negative. There's 3 negative that are like 6% to 11% negative. And the average yearly return is 9% for all of them. The mutual funds is also 9%. They also have some positive, negative. Some are more positive, some are more negative. The results of the S&P is also 9%. So basically, they're doing the same as the S&P, pretty much, both closed-end and open-end. Thus, we arrive at one of the few clearly evident rules for investors' choices. If you want to put money in investment funds, buy a group of closed-end shares at a discount of, say, 10 to 15% from asset value, instead of paying a premium of about 9% above asset value for shares of an open-end company, assuming that the future dividends and changes in asset values continue to be about the same for the two groups, you will thus obtain about 1/5 more of your money from closed-end shares because you got a discount and didn't have to pay a salesman. Okay, the mutual fund salesman will be quick to counter with the argument, but if you own closed-end shares, you can never be sure what price you can sell them for. The discount can be greater than it is today, and you will suffer from the wide spread. With our shares, you are guaranteed the right to turn in your shares at 100% of asset value, never less. Let us examine this argument a bit. It will be a good exercise in logic and plain common sense. Question: assuming that the discount on closed-end funds does widen, how likely is it that you will be worse off with those shares than with an otherwise equivalent purchase of open-end shares? This calls for a little arithmetic. Assuming that investor A buys some open shares and shares at 109% of asset value, and investor B buys closed-end shares at 85% thereof, plus 1.5% commission. Both sets of shares earn and pay 30% of this net asset value in, say, 4 years, and end up with the same value at the beginning. Investor A redeems his share at 100% of value, losing 9% premium he paid. His overall return for the period is 30% less 9%, or 21% on asset value. This in turn is 19% on his investment. How much must investor B realize on his closed-end shares to obtain the same return on his investment as investor A? The answer is 73%, or a discount of 27% from asset value. In other words, the closed-end man could suffer a widening of 12 points in the market discount, about double, before his return would go down to that of the open-end investor. An adverse change of this magnitude has happened rarely, if ever, in the history of closed-end shares. Hence, it is very unlikely that you will obtain a lower overall return from a representative closed-end company bought at a discount if its investment performance is about equal to that of a representative mutual fund. If a small load or no load fund is substituted for the one with the usual 8.5% load, the advantage of the closed-end investment is of course reduced, but it remains an advantage. The fact that a few closed-end funds are selling at premiums greater than the true 9% charge on most mutual funds introduces a separate question for the investor. Do these premium companies enjoy superior management of sufficient proven worth to warrant their elevated prices? If the answer is sought in the comparative results for the past 5 or 10 years, the answer will appear to be no. 3 of the 6 premium companies have mainly foreign investments. A striking feature of these is the large variation in prices in a few years' time. At the end of 1970, one sold at only 1/4 of its high, another at 1/3, another at less than half. If we consider the 3 domestic companies selling above asset value, we find that the average of their 10-year overall returns was somewhat better than that of 10 discount funds. But the opposite was true in the last 5 years. A comparison of the 1961-1970 record of Lehman Company, who are no longer in business, and of General American Investors, 2 of our oldest and largest closed-end companies, is given in Table 9.5. One of these sold 14% above and the other 7.6% below its net asset value at the end of 1970. The difference in price to net asset relationships did not appear warranted in these figures. So this is table 9.4. Just so you guys know, that's average results to dividend closed-end funds. And then for Instagram viewers, that's what it looks like. Cut it out, sweetie. So in 1973, funds selling at premiums had negative 5.2%. 10 funds selling at discounts had plus 1.3% growth. 3 funds selling at premiums for 5 years of 1966-1970 had 25.4% increase, whereas the 10 funds selling at discounts had 22.6% increase. From 1961 to 1970, the 3 funds selling at premiums had a 115% increase, and the 10 funds selling at discounts had a 102.9% increase. The premium was 11.4%, the discount was 9.2%. Okay. And table 9.5, I'll show you table 9.5. That's comparison to 2 leading closed-end companies. Comparison to 2 leading closed-end companies. It shows the General American Investment Corporation and Lehman. They both had negative returns in 1970. General American Investors had negative 0.3 and Lehman had negative 7.2. In the 5 years of 1966 to 1970, General American had 34% gain and Lehman had 20.6. The 10 years from 1961 to 1970, General Investors had 165% gain and Lehman had 108% gain. The discount for General American was 7.6%, where the premium Lehman was 13.9%. So the premium companies are not worth it, is what he's saying, for closed-end funds. Investment in balanced funds. This is the last section and we're done. The 23 balanced funds covered in the Weisenberg report had between 25% and 59% of their assets in preferred stocks and bonds, the average being of just 40%. The balance was held in common stocks. It would appear more logical for the typical investor to make his bond-type investments directly rather than to have them form part of a mutual fund commitment. The average income return shown by these balanced funds in 1970 was only 3.9% per annum on investment asset value, or say 3.6% on the offering price. The better choice for the bond component would be the purchase of United States savings bonds or corporate bonds rated A or better, or tax-free bonds for the investor's bond portfolio. Okay, so that is chapter 9. Back then, they did not have index funds yet. So they had investment, these mutual funds. And I read Tony Robbins' book, Money, and it talked all about why you should never invest in mutual funds. Ever. So the current mainstream advice is don't invest in mutual funds, period. Anyway. Okay, Jordan, we're done. We're going to end it. Bye, guys. See you tomorrow.